All right, welcome back to Big Money Bingo, my favorite time of the week. We're going to be watching this video called Mark Minervini, Trade Like a Stock Market Wizard with the Stock Trading Strategies. Now, I've actually worked with Mark on multiple occasions, so I'm really excited to hear what this person has picked up from his books, and I'll give you my first-hand experience working with Mark and some of these strategies as well. So if that sounds good, let's get into it. Big Money Bingo Day.
The book by Mark Minervini, Trade Like a Stock Market Wizard.
Okay, now we're off to a bad start. Mark Minervi. It's Mark Minervini.
How would you like to achieve super performance in the stock market and average 220% return per year for 6 years? We explore the book and present the key criteria Mark Minervini used to do just that. But before we begin, who is Mark Minervini? Mark Minervini is best known as a
Oh my gosh, that's going to drive me absolutely crazy. Mark Minervi.
Technical analyst, acclaimed author, instructor, and independent trader. Mark became a star in the trading community when he achieved a 155% annual return to win the 1997 US Investing Championship. Let's take a look.
And I do want to point this out, right? So Mark's won the US Investing Championship twice. I think it was 97 and 2021. And I remember he was talking to me during the 2021 one, and he's like, Chris, you know, when you are in a competition like this, you have to go hard, right? In fact, he was telling me that he was cutting his losers even shorter than he normally would. He was letting his winners run like he normally does, but his losers, because he understands that losers work against you much bigger than winners, he was saying, I'm cutting them even shorter, because I don't want that working against me. And then I don't know if they're going to pull it up here, but there was this is actually what inspired my, if you look on my high performance portfolio manager, it has little slider bars for how much you're making per month. And there were several months where Mark had nothing and then big months, nothing, big months. And that's actually what inspired me to put that on my own portfolio tracker, because it's like, you know what? You can actually do nothing and still win the US Investing Championship for months at a time. That's a lot of why when I don't trade, I'm totally content with that. Because what am I missing out on? Taking trades that don't fit my plan? No, thank you. No, thank you.
As the subtitle suggests, the book's focus is...
Oh, by the way, if you see anything, put it in the chat. Put it in the chat. I need your help so I can make sure that we get the Big Money Bingo.
...on achieving super performance in the stock market. Mark averaged 220% per year from 1994 to 2000, a 33,500% compound total return. To illustrate this incredible performance, let's look at how a £10,000 account would have grown throughout that period. This truly is super performance, and demonstrates the impact of compounding returns. The key message here is to keep reinvesting and compounding these profits. If there are frequent withdrawals, then the true impact will not materialize, and neither will the super performance returns. Mark says you must stay focused on what you're trying to accomplish. Mark classifies himself as both a technical and fundamental analyst. He relies on price and volume, and fundamentals to enhance the odds of success. The methods he described are similar to the CanSlim system that Mr. William O'Neill teaches.
And this is one of the ways that Mark and I differentiate, is because if you look at the CanSlim, current quarterly earnings per share, annual earnings per share, new product, supply and demand, a leader in that particular sector, institutional sponsorship, meaning that institutions like hedge funds, what am I trying to say? Mutual funds, things like that have big dollars, they're the ones out buying it as well. And then lastly is market direction. In my opinion, all of this doesn't matter, right? All of this does not matter, because the only thing that you're going to get paid on is if the market is moving in your direction on this stock, right? If the market, the sector, and the stock are all moving together, that's when everything just feels so easy and so effortless. And honestly, I think a lot of people get bogged down in the story, right? Trying to convince themselves that, oh, I should hold it. Oh, I convince themselves of, oh, this is such a great buy. But if the price doesn't work, then it doesn't matter. Now, Mark is extremely, extremely good about cutting his losses. So even though he has all of this going for him, he'll still cut his loss if it goes a nickel against him. He doesn't need it.
Including the cup and handle setup, which we'll explore later in the video. It is not surprising Mark uses a similar approach, because he went through the same process as O'Neill, where he studied tons of past stock winners to identify what exactly led to stock performance. Here is an example of the stock price for the company called Crocs. Through analysing such charts, he went on to formulate his own SEPA system, which stands for Specific Entry Point Analysis, to pinpoint the best time to enter a stock.
Hang on, I got a warning from back plays. Okay, I gotta deal with that later.
Let's look at the SEPA system Mark describes in the book. There are 5 key elements. The trend. The price is in a definite uptrend. Fundamentals. An improvement in earnings, revenues, and margins. A catalyst.
Okay, first off, price and the definitive uptrend, right? Follow the trend. We're going to give you B1 right there for sure. G4, 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 according to King Arthur. When did he say G4? Reduce risk. I said reduce risk, but I'll give you G4. I'll give you G4 just for funds. I'll give you G4 just for funsies. There we go. Cool. B1, we got that one. Outstanding. Yes. Hot selling product. Okay. By the way, he calls it SEPA. SEPA system is how he calls it.
A hot selling product, approval by FDA, a new CEO, or a new contract. Entry points. Enter a position at a low risk entry point. An
low risk entry point. Hopefully they'll talk about what that looks like, because I'm going to give you entry signal on that one. Entry signal on that one. What else do you see on there? G5. Oh, that was G5, not G4. Oh, gotcha. I'll give you both. Thanks, Manny. My bad. My bad. Let's continue.
Exit points. Establish firm stop loss points. Let's impose these onto the Crocs chart.
Use a stop loss. He just said use a stop loss. We're going to use that one. Very cool. Probably setups. Did he say high probability setups? Fine, I'll give you that. Man, y'all are trying to get that Dumble bingo today, aren't you? Dumble bingo today.
An uptrend begins.
Ah.
Quarterly earnings increase. A hot selling product. And a low risk buy point.
Now, this actually, I hope he spends more time on, because I've talked about this before, right? If you're looking for some sort of pullback, you want to be looking at, or it's close to those moving averages, right? Now, for me, I'm okay with buying one that's farther away from my moving average, my trailing stop, because I know I'm only going to give it a half ATR to work out. Let's see if there's one that's a little cleaner. Yeah, this is a cleaner one, right? So a lower risk entry actually was right here. Do you see how close? Let's say you're using the 10 EMA as your exit signal. See how close it is right here compared to where I got in, which is up here. Let's even measure it out. So like close down to the 10 EMA is 1.05% versus close here to the 10 EMA, 3.53%. So between these two candles, let's remove this one. Between this candle, let me just circle both of them. Between that candle and this candle. Oh, sorry. Come on. My clickies aren't clicking as easy as they normally are. And this candle, between those two candles there, right? One of those actually has higher risk, and that was where I got in. But that was not where my outlier 9 lined up, right? I got in when my outlier 9 lined up on this candle here, and it's been exceptionally profitable since that. But if you don't have outlier and you're just trying to go, using your best judgment, looking only on the charts versus all the data that you have in front of you, there's a big difference here, right? You can get in way up here, and that's even further away from the 10 EMA, right? But where I'm going with that is finding those low risk entry points. Now, because this is so far away from my trailing stop, that's where I put my half ATR risk. And my half ATR is actually even less than that 1.05% right there. My half ATR would have been right here. So even though I'm finding it higher up, entering the trade higher up, I'm still keeping my risk in check. And that's what you need to be doing. Even though you can enter at really any day, you can even enter on any day, really. You want to make sure that risk is still in check.
Exit points will be discussed later. Additionally, Mark provides a ranking process to arrive at a super performance stock. See below the ranking template. There is far too much in the chapter to cover in this review, but don't be too concerned. Most of these requirements can be filtered through several online platforms. The message, however, is simply to align positive fundamentals with immediate demand. It is clear that Mark does not consider value to any meaningful degree. In fact, the universal metric for measuring value, the
doesn't consider value to any meaningful degree. This could be interesting.
PE ratio, is discussed, and he points out that there is no magic PE number.
Okay, this is a big fundamental thing that people love to point out. What's the PE ratio? Doesn't matter.
There is no appropriate level when it comes to a PE ratio and super performance stocks. The PE can start out relatively low or high. For example, the 25 top performing stocks from 1995 to 2005 had an average PE ratio of 33x, ranging from a low of 8.6x to a high of 223x. Legendary value investor Benjamin Graham himself correlates a higher PE ratio to higher expected growth rates, as demonstrated here. The suggestion from Mark, however, is to forget this PE value calculation and seek out companies with the greatest potential for earnings growth through other metrics. Let's move on. This is where Mark really excels: trend analysis and price action.
Yeah, he really excels because it's all that matters.
There are 4 stages. Let's take a look at these in some detail, as they are paramount to the foundation for the technical setups that Mark discusses. Stage 1, the neglect phase, also known as consolidation.
Hold on. Did he just talk about stage analysis? Hold on. Let me go to that slide real quick. I believe he's going to be talking about this right here. Stage 1, stage 2, stage 3, stage 4. Comment stage in the chat if you've heard me talk about this before. Stage. Comment stage in the chat if you've heard me talk about this. And I believe that actually may be on our slide deck over here for the bingo. Hold on. Market cycle. Yup, certainly is. All right. Comment stage if you heard me talk about this before. And then let's listen to what this person put together for Mark's analysis here. This is where I learned it from, by the way. I got it exactly from Mark. Specifically, he and I talked about how important it is that you want to be riding these stage 2 uptrends, right? And do not ever think that in a stage 4 downtrend that this is the time to get in, because you're such a genius that you know that it's going to go up, where months and months or even years and years can go by before it hits the bottom. Then it figures itself out and then it starts to go back up. Yeah. Okay, cool. Everybody's heard about the stage before. Excellent. Let's see this. Oh, there's my background, by the way. There's my background, by the way. Yeah, I'm such a nerd. Shut up. I know. Okay, let's get back over to this.
Price moves in a sideways fashion with a lack of any sustained price movement up or down. Price oscillates around its 200-day moving average.
All right, stage 1, right there.
And this phase can last for months or even years. Volume will generally contract and be relatively light compared with the previous volume. Stage 2, advancing phase, accumulation. Possibly ignited by a promising business outlook, a new CEO, or a big earnings surprise that beats estimates. Volume charts will show big up bars representing abnormally large volume on rallies, contrasted with lower volume on price pullbacks. The stock price is greater than the 200-day moving average, and the price is in a clear uptrend, defined by higher highs and higher lows in a staircase pattern. Stage 3, topping phase, distribution. Volatility increases, with the stock moving back and forth in wider, looser swings. There is usually a major price break in the stock on an increase in volume. Often, it's the largest one-day decline since the beginning of the Stage 2 advance. On a weekly chart, the stock may put in the...
We did hear higher highs. You're right. Good call on that. Who said that, Jim? Outstanding work, Jim.
Largest weekly decline since the beginning of the move. These price breaks almost always occur on overwhelming volume. The stock price may undercut its 200-day moving average. And the...
Okay. I'm pretty sure he's already said something about moving average, so I'll give you that one right there.
200-day moving average will lose upside momentum, flatten out, and then roll over into a downtrend. Stage 4, the declining phase, or capitulation. At some point, there will be a negative surprise. The company will miss an earnings estimate or pre-announce earnings. The vast majority of the price action is below the 200-day moving average. The 200-day moving average, which was flat or turning downward in Stage 3, is now in a definite downtrend. The stock price pattern is characterized as a series of lower lows and lower highs, stair-stepping downward. Let's merge all these 4 stages together with a typical, simplified transition between each.
Hey, that looks familiar.
To clarify, stock selections will only be considered by Mark in the Stage 2 growth area. So having put strong fundamentals together with the right phase of a stock's trend, at which point, within this Stage 2 growth phase, does Mark buy a stock? Mark suggests buying at what he calls the pivot point. Mark frequently refers to the cup and handle chart pattern to identify the pivot point. Before purchase, there is generally a formula.
This is another area where Mark and I are not in alignment, and that's okay, right? Everybody has their own style of trading. looking for chart patterns is really hard. It's like super duper hard to me because like while this one, I could definitely see this being a cup and handle, right? I could, if it started up here and let's say it started here, came down, came back up, came down, came back up a second time, that could totally be a cup and handle. But I don't know if it looks the same for you as it does for me, right? You may have a different look at it than I do. And because of that reason, I don't do patterns. Patterns are exceptionally hard to find because they're very subjective, right? Like I said, that might be or it might not be. Versus let's look at the moving averages. You've got your 10 over 20, price over 50. That is confirmed with math. That math cannot be unconfirmed because it's just math. The 10-day moving average is over the 20-day moving average, and price is over the 50-day moving average. That is way easier to me than saying, okay, does this fit my cup and handle drawing right there, right? I always like to say that people who draw on their charts are like a 9-year-old with a fresh new marker, right? Does that mean that I'm right and they're wrong? No, it just means we have a different way to do it. And for me, that subjectivity is not okay, right? I don't want any sort of subjectivity in my investing. I want to make sure that I know exactly what I can see right here. And also, by the way, your 10, 20, 50 is going to look like exactly what we're showing here on this chart right here. Just putting it out there. Steve says, mentioned Palantir might have been a cup of handle a few weeks ago. Let's see. Yeah, exactly. There's your cup. There's your potential handle. Worked out great. Made 74.08% in 5 days, right? But then again, it continued on doing its thing, right? But I don't know if that was a cup and handle. To me, it didn't matter. You know, I had my data. I had exactly what I wanted to see, and it may or may not have been that particular pattern.
Of what Mark calls the pivot buy point. Specifically, the point at which you want to buy is when the stock moves above the pivot point on expanding volume. In this cup and handle diagram, the pivot point can be seen here. Also note how the breakout through the pivot point accompanied an increase in volume. Every correct pivot point should...
He definitely just said breakout. I heard that. And I was like, oh, wait, I got to move it over. He definitely just said breakout.
Also develop with a contraction in volume as seen here, often to a level well below average, with at least one day when volume contracts very significantly. The pivot buy point itself should be somewhere within this breakout candle. Mark suggests that the cup, or basing phase, should be a minimum of 3 weeks and can be anything up to 65 weeks. Notice how after the cup formation completes, a flattening or slight retractment occurs to form the handle. This becomes the forming of the pivot point area prior to the breakout. Okay, so we have our buy point. How does Mark suggest we manage risk? This leads us on to the exceptionally...
That sounds like me, doesn't it? Every day when we look to put on new trades, before we put on any new trades, we need to reduce risk. That is such a big deal. Such a big deal.
Important and often neglected topic of risk management. Let's use the same cup and handle diagram to demonstrate risk management, in this instance, the stop loss. Mark suggests setting a maximum downside loss limit. By setting an absolute maximum loss of no more than 10% on the downside, the average...
Which is huge. Huge. So there's two types of traders, right? People who feel like you can go with a bigger size with a tighter stop or smaller size with a wider stop. Now I know Mark goes in with big size, but a 10% stop loss is giant, humongous, tremendously huge. So that almost feels like he wouldn't go with that big a size with a 10% stop loss. Like that is so big. But we'll definitely make sure that we put in O3. Thank you guys. Appreciate that. Cut your losses. Wait, B4 bingo. No, he didn't say that. You're trying to pull that bingo. We're not quite there, squat toes. Don't get too excited. But it's going to happen, I'm sure.
Average loss should be much less, maybe 6 or 7% over the long term. In this example, it is more likely that the stop loss would be positioned here, close to the handle structure, and more aligned to a longer-term stop loss average of 6 to 7%. If you are wrong on the purchase with a 10%...
It's still huge. That is so huge.
...cushion for normal price fluctuation, either the selection criteria or timing is flawed, or the overall market is hostile, and you should be out of stocks. But remember, it is okay to be wrong. Mark says,
it is so okay to be wrong. Super duper okay to be wrong. But that's where a lot of people struggle in this game, is that they don't want to be wrong. Right? They want to be the hero who buys the stocks that only go up. They want to be the hero that says, oh, well, my trading plan is to buy a stock and sell it for profits. All right. That's not the case. Not the case every time. If you think that's the case every time, somehow you are superhuman And you should be running the stock market at this point. Don't get so caught up in your own hubris that you make all these mistakes that the amateurs make when you have professional investors teaching you everything that you'd want to know on YouTube for free without a paywall. In fact, every Tuesday and Thursday, we do something even more specialer than that.
Are you ready? Let's go!
Respect is earned. Respect is never given.
Like, I couldn't help myself right there. Every Tuesday and Thursday afternoon, we have live here on YouTube for absolutely free cost of tuition, OVTLYR University. In OVTLYR University, I'm teaching you every single thing that I know about trading. Now, we've covered 11 lessons so far, and I think we've moved a lot faster than I anticipated because we have people who are in OVTLYR University who are watching live right now who are already exceptionally profitable. And we're barely halfway through it at this point, right? So here's the deal. If you are watching this, you could be in 3 different categories. 50% of you are passively listening and nothing is happening, right? It's going in one ear and out the other ear, and you're not doing anything about it, right? It's just something to fill the time. 25% of you are listening and you're applying it, but you're not applying it correctly and you're losing money. And then you're like, Chris doesn't know what he's talking about. I'm losing money all over the place. Trust me, I see those trolls all over. Oh, Chris is so stupid. I lost money on this one trade. Yes, here's the deal. On each individual trade, we don't know what the outcome will be. But over a series of trades, if your math is going to math out, if you can have positive expectancy, you can have generational wealth. And that's what the other 25% are, right? 50% of you are listening passively. 25% of you are implementing, but you're implementing wrong. And then you're saying that it doesn't work. The other 25% of you are listening, focusing, taking notes, and actually changing your lives. And for those of you in OVTLYR University who are watching live, like Mikey Mike, and I'm pretty sure I saw Brad here, Salty Brad here earlier. Let me know in the chat. Has OVTLYR University already started to change your life? Because I know for a fact that somebody in OVTLYR University has showed me. I don't want to spoil anything, but let's say he's closing in on 7 figures of profits in just a few weeks. 7 figures of profits. So you do you, but I'm giving you everything that you need. I'm giving you everything that you need. Like Wild Stimpy. Up 46%, outstanding. Hey, there's Salty Brad. It's completely changed his life, right? We're not even done yet. David says, definitely changing my family's life. Outstanding. Manny's had his life changed as well. And guess what? OVTLYR University is covered by a full 100% money back guarantee because it's free on YouTube. Now, if that sounds good to you, make sure you hit the subscribe button wherever it is down below. All right. Hit the subscribe button wherever it is down below. And let's continue on here because I'm giving you everything that you need. Everything that you need for free on YouTube.
You can't control the number of wins and losses. What you can control is your stop loss. You can tighten it up as your gains get squeezed during difficult periods. I like to keep my risk-reward ratio intact so that I can have a relatively low batting average and still not get into serious trouble. It's a concept that I call building in failure. Mark emphasizes the importance of capping losses. He points out that he would have been knocked out of a few of his winners, but this action was overwhelmed by the loss-cutting effect. Instead of having a double-digit percentage loss in his portfolio, he would have had a gain of more than 70%. Spend a few moments, perhaps pausing, looking at this asymmetric chart to see how capping losses impact.
This is so critical. And this is where a lot of people's brains break, right? Let's say you have a 5% loss and it only takes you 5% to get back to break even. No big deal, right? We can follow the math of that. If you have a 50% loss, it takes 100% to get back to break even. Meaning, if you bought a stock at $100, it goes down to 50. Okay, $100 down to 50. That's a 50% loss. To get back to the $100, it has to go up from 50 to 100, which means it has to double. That's a 100% gain right there. Right? A lot of people can conceptualize this. It just blows their minds. What do you mean it has to go up 100%? I'm only down 50%. It doesn't have to go up 100%. If it goes up 50% from $50, that's 75. Boom. You're just hitting halfway there. Okay. So this is incredibly important. And that's why it's super all about making sure that you cut your losses, right? With some really strong and important exit signals. And you have the right mindset to follow these. Okay. You have to have the right mindset to follow these. I'm going to make sure we get a double bingo today if I can. Let's keep going.
Your overall trading performance. Notice how a 10% loss would require only an 11% gain to recover, whereas a 50% loss would require a 100% gain to recover. Mark also says that the stop can be moved up when the stock rises by 2 or 3 times the initial risk, and profits should be locked in when the trend changes. This is often...
That's what I also preach, right? Moving up your stop. I do that in 2 ways. Number one is the 10-period EMA. Let's go to something that's a little bit cleaner, like Morgan Stanley, right? It's moving up. The 10-period EMA is my trailing stop, right? And then on top of that, I'm rolling up my options. I'm taking partial profits as the trade is rolling up. But by rolling my option, I'm keeping the trade alive, okay? By rolling an option, you keep the trade alive, you take partial profits, and you can free up capital that you can trade with right away. It is such a ninja hack.
Referred to as the trailing stop loss. Let's see how this may look on the example chart here. We will assume that the initial trade risk was £1,000. 20 weeks later...
What is a pound? We need to be talking in freedom units here. What is a pound? A pound of dollar bills? Pound of $100 bills? Now let's talk.
The price increases to show a £2,000 profit. Mark would then raise his initial stop loss to a level where it would lock in a profit, arguably to a near support level and where the price would have likely breached the 200 moving average level. We can therefore assume that the first raised stop would be moved to this level, also locking in a £1,000 profit.
Right. This is exactly what I show you guys how to do on a daily basis, right? Scott says he's not even in the class, but the system works if applied. A 70% return across both his counts since mid-April when I fully implemented and understood the program. Thanks, Chris. No, outstanding work, Scott. Outstanding work. Let's all pay respects to Scott and Scat in the chat. Everybody type Scott in the chat. Outstanding. And so that's the deal, right? Is that you're in this case, you're moving your stop up because you want to protect those profits, right? There was a time in Tesla, TSLA, where a lot of people saw this giant move up, not that move, this move up. It was 124% move up that 100% evaporated. This really happened. This was a market cycle right here. Stage 1, stage 2, stage 3, stage 4. That really happened. It's not just theory. But there are plenty of people who went all the way up and all the way back down. That doesn't have to be you. It should never be you. If this is you, you've done it wrong. And you probably were so stoked when it was at $313 on the way up. And then when it was at $313 on the way down, you were probably crying yourself to sleep at night. How could I have given up all these gains? It was up nearly $500. Now it's at $313, right? Same price level, totally different feeling on the way up versus on the way down.
Repeat this for the second raised stop loss, and so on until the trend shows signs that it has changed. As we previously discussed, a change in trend direction, also known as topping, can be seen with this large price drop which closed below the 200-day moving average.
Now, when I show you guys this, I use the 10-period EMA. Is it perfect? Does it tell you when crashes are happening? No, of course. But I like to think of it as a red light and green light, right? So here's an example, right? How many times when Tesla was going up did it close under the 10 EMA, the 10-period exponential moving average? You got your 10 over 20, price over 50 stacked. Right here was the last time it closed under. It went up. This might have closed at it, but not. I wouldn't call that under it. It went up. Right here was the first time. Let's put a circle on this. I honestly don't know what's going to happen next. I don't know where we are on that, right? And then what happened? Oh, wait a minute. Actually, that was like right near the top. I was so zoomed in, I didn't know where it was. Look at this, right? Your 10-period EMA, is it going to catch you on the very top? No. And don't ever expect to catch the very top. Just be content with getting that 80% in the middle. That's where the easy money's made. 10 EMA, close under. What happened after that? That was a red light. That was a giant warning. Hey, something has changed. Okay. We're going to apply it to, let's do KKR, right? It had this big move over here. It looks like it did close under the 10 a handful of times, right? And like I say, it doesn't predict a crash, but it will get you out of the way before things happen, before bad things happen, I should say, right? You can see it move down like this, close over, it closed right at maybe slightly above, and then all hell broke loose to the downside here, right? All hell broke loose to the downside. So It's just math. Mark is using math as well, but it looks a little bit different than mine. And that's okay, because everybody needs to adapt a trading style to fit their personality.
Would certainly want to exit the trade here if your raised stops had not already done so. So, we covered what to buy, when and when to sell, but how many stocks does Mark suggest holding at any one time? Mark suggests...
Okay. Oh, I'm really glad that this came up. I was totally maxed in like 2 weeks ago. I believe it was 7 positions. And then I rolled a couple and it gave me room for an 8th. And then I rolled a couple more and that gave me room for a 9th. Now, the 8th and the 9th positions were paid for from profits from the original 7 that I had taken partial profits on by rolling the options. So while I didn't have funds to buy the 8th until I rolled it, I could then go buy the 8th. And then I didn't have funds to go buy the 9th, and then I rolled them, and I had funds to go buy the 9th. And I kept all of those trades on at once. So when you think, oh, I need to have 20, 30, 100 trades on, you don't need to do that. You really don't need to do that. In fact, your concentration is your friend here, because then you don't have as much to think about, as much to worry about. In fact, I remember one time this guy sent me his portfolio. He was like, hey, man, we review all my positions. And first off, I'm like, bro, you ain't paying me enough to do that. But then second, it's like he had a whole page worth of positions, right? Probably 60, 70. How are you going to keep track of 70 stocks? I can't keep track of 70 stocks, right? Ain't nobody got time to do that. Concentration is your friend. Go in big with size and keep your losses tight. That is how I operate. I don't want to just dabble here and there. No. I want to go in big with size because I know that the trend is my friend. I've got the outlier 9 all lined up and I'm ready to make it happen. But if you're just buying a stock here or there just for fun, you're just asking for trouble.
Depending on our risk tolerance, you should typically have between 4 and 6 stocks, and for large portfolios, maybe as many as 10 or 12.
There you go. 4 to 6, depending on portfolio size, or even up to 10 to 12, right? So falling somewhere around 7 to 9 makes total sense to me. This is where you also need to be landing.
This should provide sufficient diversification, but not too much. He states, super performance will generally not be achieved by an overly diversified portfolio. Look at the scale presented here to determine how many stocks you should hold based on your own individual risk profile. So what have we learned from this book review? 1. We have a credible author who has walked the walk. 2. Make sure the stock is within an upward trend, but not the topping phase. 3. We want to see an improvement in earnings, perhaps a catalyst in the form of a new product or contract. 4. We need a low-risk entry point, ideally around the structure of the handle within the cup and handle pattern. 5. We need a definitive stop loss set at no more than 10% to ensure losses do not snowball. Remember, we do not need to be right every time. The key is to win more when we are right and lose less when we are wrong. 6. Sell when the price trend turns down. 7. Valuation metrics are not necessary. 8.
Well, that's weird. That's weird. Are you telling me that only the price matters? I know that we can't say what we used to say, which, was like the most catchiest phrase ever. But profits follow price. In fact, hang on. Let me reinforce that point. Profits follow price. Okay. It doesn't matter what your PE ratios are. Doesn't matter what your fundamentals are. All that's hot garbage. All that matters is, are you going to get paid as the price is going up or as the price is going down? There's only one way you're going to get paid. It says the price is going up. And all that hot baloney behind the scenes doesn't matter. So let's keep filling in this bingo here. Let's keep filling in the bingo. Manny says we got to have a G3. All right, Manny, I'll give you G3. I'll give Manny a G3. Outstanding. And then Carol says we should have a G2. I don't know about that one. I don't know about that one, Carol. Charlotte says a 4B, a B4. Consistency and discipline. Oh, yeah, we're definitely getting some consistency and discipline around here. We're definitely getting some. There's one bingo. Outstanding work. We got one bingo here. Very, very cool. Dory says I3. I3. Follow your plan. I don't know. This guy, do you really think that Mark Minervini follows his plan, Dory? I mean, let's be realistic here. two-time top 100. Oh no, not top 100. Two-time U.S. investing champion winner. I don't know. Do you think he follows the plan? Patrick says, yeah, Mark definitely follows his plan. All right, fine. Yes, of course, Mark follows his plan. Are you kidding me right now? You're not going to be successful in the market if you aren't following a plan. It's just not going to happen. You're just hoping and dreaming and praying and mostly gambling. Okay. But the only way that works is if you follow your plan. Squat toast. I'm just playing around, my friend. I'm trying to have some fun. We're going for a blackout. Okay. Outstanding work. We got a double bingo today. Congratulations, everybody. Double bingo day. I need like the do sound. That would be sick. Okay, but here's the deal. Double bingo day means if you haven't typed hashtag outlier in the chat, you're not going to be available to win one of the double bingos that I'm about to give away. A $10 Amazon gift card just for fun. I will give you 20 more seconds here. In fact, I'll start a stopwatch timer. I didn't hit my 20-minute goal that I wanted to, so we'll just go for it anyway. 20-second timer here. Triple bingo? Where? I see one. I see two. There's not a triple, is there? Don't call me crazy. Don't call me crazy. Hashtag outlier in the chat if you want to win a $10 Amazon gift card just for fun, just as our way to have fun with you and enjoy a morning of coffees with Chris, right? Enjoy the morning coffee with Chris. All right. First one comes in 5, 4, 3, 2, 1. First winner is Marguerite Monchamp. Outstanding. Congratulations to you, Marguerite. Let me start typing out an email to April. April will send you that $10 Amazon gift card here. That way I don't forget who it goes to. All right, first one goes to Marguerite. Hold tight here. Got to draft this email to April. April handles all of our customer fulfillment like that. Very cool. And the second one is going to go to draw again. Congratulations, Marguerite. Exactly, Nate. Thank you, my friend. A girl. Wait, a girl's watching? Okay. Well, the joke for that is our YouTube analytics show, we have like 90% men. So to see a girl every once in a while, I was like, what's the girl doing here? All right. And the second winner of the day is, who's it going to be? Second winner of the day. Nate, what's up, dude? Nate wins. Outstanding. Actually, I had coffee with Nate one time. So congratulations to Nate for being our second winner of the day. Outstanding. All right. So Nate is the second winner of the day. To claim your prize, all you have to do is send us an email. Hit the copy button over here so I don't lose it. Send us an email over at support@outlier.com. And then once we have your email, Nate and Marguerite, we will shoot you the prize. So congratulations. All right. This is a big money bingo fun. I feel like this is like one of the most fun things that we get to do all week. Now, don't forget, I am teaching in Outlier University every Tuesday and Thursday. And also, we'll be looking at trade some this afternoon. Have a fantastic day, and we will talk soon.